Hey everyone, this is Coldwater from Phantom Trading, and today we are going to be discussing liquidity. I feel like this is a very hot topic among smart money concept traders, supply and demand traders, whatever you want to call yourself. Even retail traders to a degree are now starting to clue into what liquidity is. And honestly, I feel like this is a concept that is not well understood by people because they just don't understand how orders in the market work, how order flow works from a mechanical perspective. I go through, a lot of this in some of the articles that I've written for the Phantom Trading website. Some of them cover things like, how markets move, and that honestly kind of relates to what liquidity is. So if you guys haven't checked out some of the articles, you can actually go to resources and trading, and I believe the how markets move or what causes markets move article is under the trading section, so you can check that out here too. I would say this is mandatory reading if you want to understand what liquidity is as well, because this is just how order flow works from an order to order perspective, right? Now moving on, so what is liquidity? I'm going to show you guys a bunch of examples of what liquidity is, and I'm also going to go over the different types of liquidity and how we're going to cover basically how we can use liquidity in our trading in order to improve our edge. It's very important that we understand these concepts, because with just using structure alone, supply and demand, I really don't think it's sufficient to help, or I don't think it's sufficient enough to actually analyze the market properly. Okay, so let's dive into what liquidity is. I'm going to give you guys a very simple example so that it makes sense and it's easy to understand. And then we'll go over a chart example as well, just so you guys really drill it into your heads. But I'm going to go over the dead basics of what liquidity is. I put together this diagram. Imagine this is a random Forex pair or stock or index or crypto, whatever you want to call it, right? It's a chart. On a nondescript time frame. This could be the daily, 4 hour, 15, 1 minute, whatever. Doesn't matter. Liquidity is sitting basically everywhere on all time frames, right? So we can kind of look at it like that. Now, obviously, is liquidity going to collect in larger concentrations on higher time frames? Absolutely, right? But does that mean there isn't liquidity collecting on lower time frames? No, right? So as you guys can see here, what do I have? I have a bunch of little lines, dash lines, labeled orders, right? And that's all liquidity really is. In its most simple form, it is a collection of orders sitting below lows and above highs, right? Now, whether that's a swing point or it's a support or resistance zone, or equal highs or equal lows, as SMC traders like to call it, there's liquidity sitting at all those levels, right? Now, one thing to mention, right? As much as we have liquidity that is kind of sitting here in different pools or whatever you want to call it, really the truth is you have orders that are kind of sitting all throughout price, right? Just in different concentrations. That's really all it is, right? So we're kind of thinking, where are the orders congregating? That's really what we can view as liquidity, right? Now, liquidity can be used in all sorts of ways, right? I'm going to go over a couple of the ways that we kind of use it as traders, and the way that we're kind of theorizing that the larger institutions and banks are using it to manipulate price in order to trick people into, getting into weak-handed positions, taking their liquidity, right, and then pushing price one way or the other, right? I'm not going to get super deep into the theory of it, but I'll quickly explain this. The whole idea is, banks, with the amount of money, or financial institutions for that matter, with the amount of money that they have and the size of position that they want to get into, they physically cannot get into their position without building that position, right? If you guys understand, just how markets move in general, I'll quickly explain it. Again, that article I mentioned earlier goes into good depth about it, about how the market moves from tick to tick, right? It operates on the same principle. The whole theory and reason behind it is they need to build a position up, right? If a bank, I'll draw a little bank here. Ignore my drawing skills, they're not that great. Okay, so imagine we have a bank, a financial institution, right? And they're sitting here and they're like, okay, I want to put on, $1 trillion, maybe not $1 trillion. Let's say they put on, a million lots long on euro dollar, right? In order for them to do that, they have to manipulate price and push it around in order to generate the liquidity, right? To actually get into that position, right? They're basically taking liquidity from here, all over the place, right? Sweeping people out of their positions so that they can fill their bags enough at, an average price, right? To actually build that position. If they were to enter long instantly, a million lots into the market, what do you think is going to happen? Maybe you don't know. Maybe you don't understand, the dead basics of how markets operate. But I'll tell you, price is going to go like this, right? It's going to shoot up. And what's going to happen? They're going to get slipped, right? Because there's not enough liquidity or, sellers on the opposite side of their action to absorb all of the buying pressure, right? So again, I'll step back for 1 second to quickly explain this. The reason price moves up or down in a market is because there is an imbalance between buyers and sellers. It means that, in the case of the market moving up even one tick, somebody has enough conviction to buy enough to absorb all of the sell orders on the opposite side, right? So they are bidding the price up, right? And that moves price up by one tick, right? So say it's, 0.01 to 0.02 or whatever it is, right? In the case of a stock, it'd move up in a cent, as a cent, right? I believe a tick is like 5 decimal places or whatever. Again, I wrote a whole article on all of that. If you guys want to read it, it's, the basic beginner's guide to Forex trading. Again, it's on our website. We talk about pips and ticks and all sorts of stuff. But anyways, moving back into it, this is the whole reason liquidity is kind of built, right? It's because, again, these institutions have to build positions. They have to generate liquidity in the market. How are they going to generate the liquidity? It's by pushing price around so that it collects, right? Whether you are a breakout trader, you trade supply and demand, you trade retail trading, you trade EMAs, doesn't matter. Maybe you're a scalper, maybe you're a swing trader. The fact is, no matter what position you get into, in a way you are adding to different liquidity pools in the market, right? And typically, those liquidity pools are going to build up based on, a particular strategy, or, if it's a swing point, it just makes logical sense, right? If you're buying from a swing low like this, of course, you're going to put your stop loss somewhere around here, right? So kind of think of it, as that, right? Now, diving into it a little bit deeper, there are two different types of liquidity that, I'm going to quickly discuss, right? Okay, so let's discuss liquidity to target as our first type of liquidity. I actually missed one of these levels here, so I'm going to quickly drag it over. But all liquidity to target is if you're in, say, a long position from this level, I've actually drawn out like, a supply or demand level, technically a demand level here, a POI, right? Imagine you are in a buy order here, right? And pretend that your stop loss is sitting, at one of these levels, right? Where all these orders are collected. Again, you technically might get swept out as liquidity, right? Again, we teach all this in phantom trading, teach you how not to get swept out, right? But does it happen sometimes? Yes. Of course, trading is a probabilistic thing. You're not going to win every trade, right? Like, be real with yourself. So what is liquidity to target? So again, if we're in a buy position here, all liquidity to target are certain levels that are kind of sitting in the way, right? That we're going to look to target. So it's really that simple. If I'm in a buy position here, of course, I'm targeting this liquidity that's sitting here, this liquidity that's sitting here, this liquidity that's sitting here. And what sometimes happens when we run a level? Typically, you'll see some sort of a pullback, right? So a lot of the time, and again, I'm not going to go into too much detail about this, right? But depending on structure and depending on, where you are in the day and if it's late in the session, stuff like that, you may look to take heavy partials at a level like this, right? And why would we do that? Because price could very well pull back or even reverse, right? So really all this is liquidity to target, because there are a collection of orders here, right? In some cases, price will sweep it and reverse or pull back. In other cases, you have liquidity that is here as almost fuel for the move, right? And why is it fuel for a move? I'm going to explain that. I'm going to try to explain this again in a simple fashion so that it makes sense, right? But you have essentially two types of orders that are kind of sitting here. Number one, you have people who have their sell limit orders. I'm just going to delete this for now so that you can kind of visualize this. You have people who have, their sell limit orders that maybe they got tapped into, their stop losses are sitting at any one of these levels, right? That's one type of liquidity. You almost imagine there is a buy order sitting right here, right? Why? Because if you're shorting a particular financial instrument, you have a buy order that is there to cover the short in the event that price goes against your order, right? Okay, pretty simple, right? On the other hand, you also have people who are breakout traders who use buy stop limit orders that are kind of sitting like this, right? And if you don't know what a buy stop limit order is, I'll quickly explain it. All it is a limit order that basically gets triggered from the other side. So your typical buy limit order is, okay, say you have price coming in, it taps into your limit, okay, you're now in the position, your stop loss is down here, right? On the other hand, your buy stop limit order, there's also sell stop limit orders, which are just a short version of this. But what a buy stop limit order is if price is coming up underneath, you have your limit here and your stop loss here. As soon as price crosses over this level, you are now in your buy order, if that makes sense. So you have to imagine at these levels, these highs and stuff, you have people who are ready to buy the breakout. They're expecting price is going to do this, right? And they could very well be right. And in this case, right, if we are correct about our analysis and everything, those breakout traders are also technically correct, right? And we're all trading the same trend. We're trying to ride that move, right? So why is any of that relevant to this, right? You have to think the same thing as somebody who is selling with their buy order, right? Say they're selling short, their buy order is sitting here. It's sitting there as a buy order ready to trigger more buying pressure, right? Naturally, right? Because there's a buy order. And same with people who have their stop limit buy orders there. It's the same type of order technically, right? Because as soon as price intersects through it, moving up, it's going to create upward buying pressure, right? So that's what liquidity to target is. It's fuel for the move, right? Now here's the thing, it's very easy to confuse the two types of liquidity. I'm going to go over the next one, which a lot of people like to call inducement in the SMC space. But it's very easy to confuse the two. And again, if you don't know what you're doing, it's very easy to be on the wrong side of the market, right? So in order to be on the right side of the market, I really believe you need to add context to, your entire analysis, right? It's important that you do multi-time frame analysis, especially if you're going to trade something, like SMC or supply and demand. And then obviously you need, things like structure, supply and demand zones. You really need to understand the interaction between buyers and sellers. Without all of that, again, it's very easy to misinterpret this as, quote unquote inducement, and that price is going to shoot the other way after it sweeps it, right? Now, does that happen? Obviously it does, right? But you need a way to identify it accurately, right? And again, at Phantom Trading, we give you all the tools that you need in order to build that skill. It is not an easy skill to build by any means, but it's definitely a necessary one if you're going to try and trade this way, right? And here's the thing, even if you trade retail strategies, you could even trade EMAs. Understanding this stuff, I honestly think is really useful, right? Because it's another kind of weapon in your arsenal that you can use to get a more accurate idea of what the market is most likely to do for whatever session you're trading, whether you're a swing trader, whether you're day trade, doesn't matter, right? So let's go over inducement next. Okay, so inducement, again, it's a big buzzword, right? It's basically the idea of tricking buyers or sellers, right? While the institution, bank, whatever is building their position, right? Typically it's an accumulation for buys, right? It's a distribution for them to offload a position that they've already profited off of, right? Maybe they bought down here, right? And now they have to offload. It's the same way, by the way, for them to get out of a position. It's not like they can just sell. Otherwise they're going to tank, whatever instrument they're trading, right? They have to slowly offload it by generating liquidity and then selling to these people, right? So quick mini lesson within our mini lesson here. So what is inducement? Or, I don't know what else you can really call it. It's not really what we call it in Phantom Trading. It's just a different type of liquidity. We have different terms for it. But anyways, what is it? Basically, it's liquidity that's sitting sort of internally that is going to get swept out, right? Again, it's institutions generating liquidity so that they can take it and then take price in the intended direction that they originally intended, right? So in this case, all of this liquidity that's kind of sitting in here, and honestly, it's not as simple as what I've drawn out in this diagram. There are certain rules that we stick to in Phantom to actually classify this type of liquidity. I'm just giving you kind of like a general idea of what it is, right? Even here, right? And again, you can draw liquidity whatever way you want. Again, the reason I've put together like this sort of stack of orders is just to give you an idea to visualize where orders are stacked, where the liquidity is, right? So you have to think, anybody who is, even buying at one of these levels, let me delete some of these drawings and just explain, right? Technically, you have a supplier demand level or a level of support that's kind of sitting here, right? So imagine you buy here, right? And here's the thing. I want to be clear about this. There's nothing wrong with buying at, this level if it's like an intraday scalp that you want to do, right? If this is like the 15-minute and there's a nice POI that's sitting here and you know that there's a POI sitting below it or a level of support that's sitting below it and that this is potentially going to get run, there's nothing wrong with taking a quick position here, just knowing that, potentially is going to get run. Look to TP early, right? You take a quick 6-5 hour trade, whatever, right? Nothing wrong with that. But the thing is, if you're going to hold it anticipating that this is going to fly up, right? And which it very well might do. Again, anything can happen in the market. I'm not saying that it has to do this every time, right? A lot of it depends on market conditions and again, the context behind it, right? What the trend is like, if we're even trending or if we're, in a range, right? Things like that, right? But you have to think, there are basically stacks of orders sitting here, right? Liquidity, people who are buying here and maybe holding for a little bit too long. They have their stop losses sitting below here. And in the case of somebody who's in a buy order, what is their stop loss? It's a sell order, right? In order to get out of a buy position, you need to sell your position, right? So same thing, right? It's the same principle that I talked about on the flip side with liquidity to target, right? Or liquidity that is there to fuel the move. In this case, you have it there so that within this larger overall range, the bank or financial institution is able to build their position at around this average price, right? Now, they're not going to get the best price, but listen, they have so much money, they have to kind of push the market around again in order to build, their position in the case of a long, right? So in this case, again, you have buy orders sitting here, a sell order sitting here as a stop loss, and then same thing, you have breakout traders that are sitting here that are trying to short this in anticipation that this is going to break out lower, right? And again, if you're shorting, doesn't matter what type of financial instrument it is you're trading, right? Well, maybe if you're trading stocks, so you have obviously commissions and stuff on top of that, right? Maybe it's a little bit harder. Maybe it's a stock or equity that is long biased, right? Which they pretty much all are. In the case of Forex, we know that price oscillates because you're trading a currency against a currency, right? So again, I don't want to get too detailed or confuse you guys with this too much, but the whole idea is if you have somebody who's sitting here with a sell stop limit order, then essentially when price intersects with this, again, it's more selling pressure, right? Or essentially you have somebody who is selling at this level, right? And are they going to get taken out of their position? Yes, right? So technically, the institution is able to build more positions with people who are trying to sell at these levels too, right? So price comes in, taps into it, you're in your position, look, you get taken out right away as a breakout trader anyways, right? And there are people who trade like this and there's a profitable way to do it, obviously, right? I'm a very firm believer that you can trade any strategy. I mean, there are so many strategies out there. There are a ton of indicators. I'm not saying that, every single one is perfect, right? But I think, and I know of people that actually trade retail strategies successfully, right? And same with, supply and demand, SMC. It's a great strategy, right? If you understand how to do it properly, right? So again, moving on, what is all of this liquidity that's sitting here, right? And again, I'll draw like an arrow to give you guys an example. All of this is going to get swept out, right? As the bank or financial institution is building their position, it gets swept out. They push price down back to the original level that they were trying to buy at, right? And now they've filled their bags at enough of a low price that they can take price in the intended direction that they originally wanted to take it, right? So they're able to profit off of their huge position which probably has, you know, an average, you know, price of around here. This is their average level that they were able to fill their bags at, and this is their, you know, stop loss, even though they probably don't use a stop loss, right? And there you go. They take their, you know, million lots long that they've built up over this average price, and they're able to profit off of it, right? And so that's all, you know, that's all inducement is essentially, right? So you have those two basic types of liquidity. Again, this may have flown over your head, honestly, right? I urge you to go read some of the articles. I talk about this in more depth, and I think in a little bit more clarity than I did, you know, trying to explain it on this video. But let's quickly go over a couple real world examples on GBP USD. That's just what I have open, so I'm gonna, you know, try and find some and show you guys. And then yeah, again, if you want to learn how to, you know, do all of this, we teach how to do it in Phantom, right? So it's not like you have to reinvent the wheel, sit here and try to figure out what liquidity is and how to use it within your trading strategy. We've done it all for you, right? So let's move on to some real world examples. Okay, so we are currently on the 4-hour on GBP USD, starting with end of April 2022 all the way to present day, which is now June 23rd. It is hot. It is summer. I sound like a weather forecaster, but anyways, I'm gonna mark out all the liquidity that's sitting here. I actually want to show you guys another, you know, small nugget or tidbit that, you know, may be kind of useful for some of you, because I know when I first started out trading, I would mark out, well, trading, you know, supply and demand, I would mark out these zones and I'd be like, man, why the hell did that not work, right? Just because this didn't work doesn't mean you can't trade shorts from in and around this level, right? I'm going to explain why in a second. First, let's mark out some of the zones. I'm going to use this huge arrow tool. I know it's kind of ugly, but just because it's, you know, nice and easy to read, right? So there we go. We have liquidity here that technically is used as inducement, right? Why? Because it sweeps it, and then what happens? Price pushes lower, right? Same thing that I was talking about before. Now, on the other hand, do we have liquidity that we can use to fuel the move? Yes, we do, right? And why is this liquidity to fuel the move? It's very simple. Again, I'm not going to go into the details about it, but it's as simple as, or basically I'm going to give you the simple explanation of it. We're in a bearish market, right? So typically price is going to continue to push in the same direction that it's already trending, right? It just makes sense. It takes a lot of money to reverse a market, right? So think of it that way. So we have liquidity here. Technically that's at a high, a swing high. I would consider this a swing high based on the structure here, right? And that's getting run, right? And this happens actually quite a bit with things like, with instruments like pound dollar. It happens with euro dollar a little bit as well. But listen, like, you can expect that this is going to happen, and you can trade it, right? Just because price, you know, technically, I mean, some people would view this as it breaking up, right? Just because price came up and swept does not mean that we now just look for longs, right? We're coming from an overall bearish market, right? And that's why I wanted to show you guys this example, is because it's very simple. It's a little nuanced, but it's a good thing to kind of keep in your head, right? Not everything is what it seems in the market, right? A lot of manipulation going on. Why? It's because, again, the institutions are trying to build positions so that they can take you out of your orders, use liquidity, and then profit off of their position that they've built up, right? Or offload their position that they've already profited on, right? So there you go. There's some. Let's draw a little bit more here. Again, we have some liquidity that's kind of sitting here. What happens? Does it sweep this high? Yes, it does. And then what happens? Price absolutely dumps, right? And again, are we using this as liquidity target? Yes, right? Same with all of this technically. Remember, there are orders sitting at all these lows that are ready to get run and fuel. It's almost adding fuel to the fire, right? It's adding gasoline to an open flame. Look, you have this explosive this explosive move down, right? Price action shoots to the downside because of it, right? Where else do we have, you know, inducement? Let's see. Technically, I'm trying to see if there's a break here that we can kind of use. Let's actually scroll a little bit through price here and see if I can find another one that's really clear. So I'm going to use this line tool to kind of mark out a break as well, so that it makes sense to you guys, because that's kind of part of it. And let's just make this a little bit bigger and easier to see. So I would say, okay, we have a break of structure here. This is probably a minor break, or could be a swing break depending on how you view structure. But essentially, you'd be thinking, okay, this level broke this low, right? This should, in theory, be a protected high. Is that what happens? No. Does it get used as inducement? Yes, right? And same with this one too, right? Now this one doesn't break anything, but you would think, right? If it got swept, maybe okay, then I can short it, right? But no, the sweep gets swept, right? And what does it sweep into? In this case, it looks like it sweeps into this range created supply, right? Or window of imbalance, or whatever you want to call it, right? So again, another nuanced way of kind of reading it, right? I'm trying to think, is there any other levels here? Potentially this one. Why? Because this technically breaks these lows here, right? At which point you're maybe thinking, okay, let's try to short off of this. What happens? You get swept. What actually holds this level here, right? So again, this is liquidity that's here, that's, you know, essentially being built, prices being manipulated to trick people into selling at this level. They get swept out, price taps into it, it shoots off, right, to the downside. So same kind of principle. Now in terms of liquidity to target, same thing, we're in a downtrend. So where is our liquidity to target? What is going to add fuel to the fire? All of this, right? And in a way, it's kind of funny because this stuff is as simple as, you know, kind of reading trend in a way, right? If you're in a downtrend and you see pivot point lows and they're failing to break highs, you can expect they are going to get used as fuel for the fire, right? The fire being bearish price action. So anyways, that is my little real world example on an actual chart on GU. I urge you to go and practice this if you want to learn how to use liquidity within your trading. Again, it's not like it's just specific to SMC and supply and demand, though it is most commonly used with this type of trading. You can use this in retail strategies. I mean, again, you could use it with EMAs if you wanted to. I think it's a great concept. Again, it helps you identify where you may get swept out, right? Doesn't matter what time frame. It could be the 4 hour like I've shown you here. It could be the 15, even on the 1 minute. I mean, we use liquidity on the 1 minute all the time in Phantom, right? So again, if you guys want to learn how to trade this way, check out phantomtradingeffects.com. Check out the articles that I've written on, you know, both how markets move, what causes them to move, as well as my article on liquidity. We have all sorts of cool resources that are on the site for free. If you're serious about making trading your actual career and, you know, making some actual money out of it, you know, getting funding through a prop firm, I urge you to join. You can join our community of, I believe we have like 2,000 people within the community right now. We have, you know, live streams 2 to 3 times a week. You know, Fridays I typically do a back testing call every other Friday. Some of the other coaches do live streams during session, either during London lull or what we like to call like New York talks, right? We're talking, it's Aaron and Tricky that are doing like a New York call. We run them on Zoom. And then you also have Blackwatch, who does a market commentary pretty much weekly, right? I believe on like Sundays or something. So a lot of like awesome learning resources. That's obviously not even including the entire course that we kind of go over. It covers all of this stuff and more, right? So again, if you're looking to actually trade seriously, join Phantom. Let me know what you think. I'm in the Discord. You could DM me anytime. And let me know what you guys think of this video too. I hope I explained liquidity in an easy to understand format. If you don't understand it, feel free to ask a question in the comments. I'm happy to clarify. Anyways, happy trading everyone. Thanks for watching and have a great rest of your week.